Hello again, it's your boy back at it again with another video. Today we're going to talk about something that I've only really mentioned in passing in previous videos. Bitcoin as a currency. Because if you've watched my previous videos, you know that right now I'm not necessarily sold that that's its primary role. That it's, necessarily the best instrument for that right now. In the line goes up response video, I specifically talked about the importance of avoiding hyperdeflation when we're talking about using a currency on the scale of an entire national economy, especially when we're talking about modern countries, which tend to have really high debt to GDP ratios. So that tends to be really important because if they're debtor states, adopting a deflationary currency as their standard is going to be a real big issue. And virtually every state right now is a debtor state. In my case for crypto, we also talked about, the volatility and how that's been kind of trending downwards over time as market cap goes up. In my previous videos, I've said that, nobody really knows when exactly these problems are going to be solved, but they are likely to work themselves out over time. Now, it's still the case that nobody really has that answer, but that doesn't stop us from trying. So today, I'm going to take a crack at it. We'll see how it goes. I suspect there's a good chance my, projections are going to be totally off because I'm going to be largely projecting, decades into the future here. And really even PhD economists have difficulty with projecting even a year into the future with any certainty. And I'm not even that kind of doctor. So who knows how this will turn out. So just keep in mind that these numbers are kind of more useful as a thought experiment than anything else. It's really the concepts that are important here. So let's get into it. What are the hurdles that Bitcoin needs to overcome in order to be able to be used as a kind of a daily transactional currency? The way I see it, there's mainly two. Some people might point out a third, but I really think it's mainly these two. One, as we talked about just a second ago, is deflation or adoption. I kind of see this as the same problem. We'll get into that in a second. And the other problem is volatility. Right? So volatility and deflation / adoption. The third one, we'll make a brief note of that before we move on. The third one would be performance, but I don't really think that this is much of a hurdle. It's the easiest hurdle because effectively we have multiple options, and not only do we have options, we have at least one dominant option that has been extensively developed and is kind of more adopted than most of the rest when it comes to the Bitcoin network. As I discussed in the line goes up response, the future of blockchain scaling is primarily going to be layer 2, right? So for one, maintaining security and decentralization on the layer 1 blockchain is really a priority that you can't really de-emphasize without making major trade-offs when it comes to things like censorship resistance and fraud. Also, trying to scale everything on layer 1 leads to that tragedy of the commons problem that I mentioned in the line goes up response, right? When you have one dApp that is just congested and everybody's using it, it slows down all the other dApps because everything is being done on the layer 1, and that indirect congestion just becomes a huge problem for people who aren't even using the relevant dApp. If you're interested, you can learn more about this in my excerpt from the line goes up response in the top right. Now, with respect to Bitcoin specifically, the one layer 2 solution that has been, kind of developed more than the others, really at this point kind of adopted a little bit more than the others, is the Lightning Network. Now, I don't necessarily say that, the Lightning Network is perfect by any means. There's definitely drawbacks to the solution that they've chosen here. This is a state channel-based solution. We're not going to get super deep into that right now because frankly, that's its own video. If you really want to understand the drawbacks of Lightning Network and state channels, it would require its own video. You do need a little bit of a technical knowledge for that. For now, check out this video of a Bitcoin Lightning card transaction next to a MasterCard transaction.
So we're doing a fiat versus Bitcoin Lightning pay test in Gibraltar. £2.20 loaded on both screens. We have Bitcoin versus fiat. You ready? 3, 2, 1, go. Ooh, is that? Lightning's done it. There it is.
So let's get to the harder problems, and we'll start with volatility. As we've seen previously, and I'll show it again here, Bitcoin's volatility has really been going down over time as we see its market cap go up, which makes sense, right? With a bigger market cap, more money needs to move in or out in order to move the price up or down. Now, you can see that there are cyclical spikes in volatility, mostly centered around like the halving events, but in general, the trend has been lower volatility to higher market cap, which is nice, but we're here for specifics. So the natural next question that we should ask at this point is, how much volatility is acceptable for an everyday transactional currency? I think how you answer that question probably depends on what you think a currency should resemble, right? And so here we're going to go over the volatility of the two broad asset classes that people think of when they think of this question, right? We'll go over commodities, specifically more like gold, and currency, US dollar specifically. Here we see the annualized volatility of certain commodities and commodities indexes between 2009 to 2019. And if we zoom in specifically on gold, we see that it has roughly a 15% annualized volatility. Now, we don't use gold in today's globalized economy, and for actually many good reasons. To name a few, there's like 5 countries that have, the majority of the world's gold mining, right? Gold in mines that you can actually get. And on top of that, there's actually not enough gold to back the entire international monetary system right now. The only way that you could actually get gold to support the entire financial system and all the transactions of the world right now is if you basically went back to a reserve system, right? A fractional reserve system like we have now. In which case you just recreated a fiat currency system, except now you don't have at least the central banks who are at least required to pretend that they give a crap about you. Now you just have regular banks who are pretty much entitled to treat you however the heck they want. And that's kind of a crappier system. Not to mention, gold has actually lost value against inflation when benchmarked to the United States dollar over the last 50 years, so it's not an inflation hedge, which is one of the properties that people often like about Bitcoin. So that's gold. When we look at the volatility of fiat currencies, we see something completely different and something I wasn't expecting at all. If we look at the average 1-week volatility of various trading pairs and compare that to the 50-week average volatility of those same trading pairs, we see something interesting. It's actually remarkably consistent, right? They actually center around 1%. All of them, almost across the board. So, with respect to each other, the majority of the fiat currencies that we see in the Forex market that people actually trade, they vary with respect to each other by about 1% in the short and medium term. So if we're going after the goal of being able to use Bitcoin for daily transactions on a global scale in a way that plays nice with the other currencies, so long as they continue to exist, that seems like a really good goal. Okay, so we're aiming for a 1% volatility on average in both short to medium term scales. How are we doing? How much is Bitcoin's volatility right now? Here's the average 30-day volatility of Bitcoin over the years. We can see that some years are way more volatile than others, and no years so far have been even close to 1% average volatility. And no, that 2% doesn't count, as if we refer to the graph from earlier, we see that 2016 only came out that low because some of the more volatile months were balanced by some uncharacteristically non-volatile months. A lot of these average monthly volatility numbers are around the 4 to 5% range, but if we refer back to the graph, we see that there's actually a lot of averaging out of highly volatile months and non-volatile months that still leaves us with 4 to 5% volatility. Neither the graph nor the table really gives us an exact idea of when exactly we're going to get to this 1% threshold that we're looking for. I think the reason that we're not quite seeing the light at the end of the tunnel here is because the end of the tunnel is a long way off. So instead of just bashing our head against this wall over and over again, why don't we take a look at the next hurdle and see if this investigation gives us a more accurate idea of the timeline here. The way modern monetary theory thinks about inflation and deflation isn't exactly black and white. In fact, you can complicate this issue almost infinitely if you really want to. Now, I'll put a video in the description in case you are really interested in getting into the weeds there, but for the sake of this video, we'll keep it simple. Too much inflation is bad and too much deflation is bad. Now, central bank monetary policy that targets a slightly inflationary target is generally thought of as expansionary because it encourages people to spend money, and it also encourages people and institutions to take on debt to do stuff. After all, why not spend your money if it's actually going to be worth less tomorrow? And also, it's less of a burden to take on more debt if over time you can count on that debt, the real value of it, going down because inflation is devaluing the currency. Deflationary policies are generally seen as contractionary monetary policies because they do the opposite of these. It makes people stop spending and it destroys debtors, because your debt ends up being more over time. Modern fiat currencies generally don't have deflationary targets. One, because really it's difficult for central banks to actually accurately have a deflationary target and really control it with the current instruments available. But then also, classically monetary policy, like I said, it considers it contractionary, so they wouldn't generally want to target that. Now, I will say that modern economists have had a slight potential change of heart on this. Some of them, not all of them, this is somewhat controversial, but some have said that deflationary targets, small deflationary targets, can potentially be at least survivable, if not potentially even good over the long term. But once again, quite controversial, and for our purposes, it's not quite enough simply because, the exact number there is not, set in stone. People can't even agree whether this is the case, much less what that target would be. So really, we're just going to have to work with what we have. Bitcoin, as we know, has 4-year halving cycles, at which point, the issuance rate is cut in half. The issuance rate will therefore predictably decrease steadily until around the year 2140, at which point the last Bitcoin will be mined. Until then, this would predictably be a driver of deflation in the currency. But that's more than a full human lifetime away and doesn't really help us because of that, despite having a hard, predictable endpoint. Let's look for a moment instead at the other side of what drives price: demand. Demand is going to track heavily with adoption and development, which are hard to project even 1 year into the future. So then, are we at a dead end? I don't necessarily think so. We're just going to have to start abstracting a little bit. Instead of trying to predict exactly how and when adoption will progress, let's instead look at market cap milestones. As we reach a point of adoption, semi-saturation, or saturation, the market cap of Bitcoin will likely reach certain milestones that are, achieved by markets that use the US dollar and the US dollar itself. Here, we'll pretty much be doing what we did before, except we'll be looking at the market capitalizations of global stock markets and the US dollar money supply. The US stock market, as you can see here, has about a $40 trillion market cap, which is about 80x bigger than Bitcoin is right now in 2022. Why do I mention this? This is actually not too germane to Bitcoin itself, except that to say that this amount of liquidity is investable. It's there. It's available to potentially go in. Interestingly, long before we get to that point, we will have passed another major milestone, which is the M0 money supply, which currently sits at about 5.5 trillion. Now let's back up a moment briefly and just kind of clarify what I mean by that. The M0 money supply, otherwise known as the monetary base, includes coin currency, physical paper currency, and central bank reserves. This is all of the completely liquid money in circulation. Then we have the M1 money supply. This is what we call narrow money. So that includes everything that's in the M0 money supply, but also traveler's checks and demand deposits not in reserves. And then we have M2 money supply, which includes savings accounts, time deposits less than $100,000, and retail money market funds. Now, there used to be an M3, and then they replaced that with money zero maturity, and then they discontinued that, and they just don't keep track of anything higher than that anymore. The next milestone we can look at is the M1 and M2 money supplies, right? So once again, before you ever get to the US stock market milestone, you're going to hit M1 and M2 money supplies, which are currently about $1 trillion off from each other. M1 is currently around 20 trillion, M2 is about 21 trillion. This is roughly where I think we'll start reaching semi-saturation for demand and adoption. After all, the US dollar is the world reserve currency and is used to transact on a global scale. There's even examples of when it needs to be used, like for instance, all oil transactions since the last Bretton Woods Convention are required to be done in the USD. Once you get to a market cap that can account for all of the USD money supply, the world should pretty much be able to make do for all daily transactions. But unlike the USD, Bitcoin is deflationary. People tend to invest in BTC more like they do with stocks than they do with the US dollar on the Forex market. As such, I think demand will start to slow down once we reach that M0 money supply at 5.5 trillion, and then slow down again at around 20 trillion, and then pretty much cease to be a factor as we close in on 40 trillion. Now mind you, I'm talking about these numbers in terms of today's money, right? The US dollar tends to be degraded by about 85% of its value every 50 years. So if you check back on these numbers in 50 years, it's not actually going to be the same numbers I'm talking about, right? It's going to be in future money, which is going to be in 50 years, at least 85%, maybe even more degraded by inflation. Of course, it's impossible to give a real time frame for when exactly we'll reach these milestones, but admittedly, with BlackRock more recently buying in, it may be much sooner than I'm anticipating right now, right? I'm saying decades, 50 years plus, it could be sooner than that. Now, this is all pretty indirect, right? I'm saying things like demand, but really what is important is adoption. As Bitcoiners are fond of saying, 1 BTC equals 1 BTC, which is really just another way of saying that it's potentially a mistake to think of the value of a Bitcoin in dollar terms when the point is kind of to stop using the dollar. The obligate outflows in the modern day are really a result of having to cash out your Bitcoin to do useful daily transactions. Right now, in 2022, El Salvador is basically the only place on earth where this is not the case. Once we start reaching saturation and adoption starts to, help us minimize the need to cash out of the Bitcoin network, that's when I really think that the rate of rise in the price is going to slow down significantly, such that the deflationary pressures taper off even more than they already have. Once again, I couldn't guess at a year that this would potentially happen, but at the very least, these market cap milestones are something to look out for as a promising surrogate. And there you have it, my dubious and contentious thoughts about, when we'll get to be able to actually use Bitcoin as a currency and have it work the way that we want to on national scales. I know that, Michael Saylor definitely disagrees with the idea of the price rise, slowing down any time in the foreseeable future. I'm sure some of you disagree with any of these points rather heavily. I'm even more sure that most of these will probably be invalidated at some point. Once again, I'm projecting really far into the future. Who knows? Speculating decades into the future is fun, but nobody can really do it accurately. But hey, please do tell me in the comments down below what you think. I'd love to get new perspectives on my little theories. And of course, as always, please be sure to drop a like if you liked the video, subscribe if you'd like to see more, and thanks for watching.